There's a specific kind of vertigo that hits the average investor when a company like Microsoft stumbles. We have been conditioned over the last decade or so to view these tech giants not just as companies, but as the structural pillars of the modern world. They feel permanent. They feel inevitable. When you open your laptop, there's Windows. When you open your spreadsheet, there's Excel. When you save a file to the cloud, it's likely sitting on an Azure server. So when you see a headline screaming that Microsoft has dropped 5, 10, or 15%, or that it has shed hundreds of billions of dollars in value in a single week, it feels less like a stock market fluctuation and more like a crack in the foundation of the economy itself. But I want to offer you a different lens today. I want to suggest that the panic you feel when a giant dips or the FOMO you feel when it soars comes from a misunderstanding of one very boring, very critical concept: market capitalization, or as it's usually called, market cap. Once you truly grasp the physics of market cap, and I call it physics because it deals with gravity, mass, and resistance, Microsoft's big drop doesn't look like a catastrophe. It looks like a mathematical inevitability. It looks like the system working exactly as it was designed to work. Just a quick note before we dive into the mechanics of all this: everything we talk about here is for educational purposes. I am not a financial advisor, and I am certainly not your financial advisor. This is about understanding the landscape so you can make your own decisions, not a prescription for what to buy or sell. To understand why a drop in a massive company matters and why it might not matter in the way you think, we have to strip away the brand name. Forget that it's Microsoft. Forget the AI hype, the gaming division, and the office software. Let's look at it purely as a pile of money. Market capitalization is a simple equation. It is the current share price multiplied by the total number of shares in existence. That's it. If a company has 1 million shares and they trade for $10 each, the market cap is $10 million. It is the price tag the market has placed on the entire business right now, today. When we talk about Microsoft or Apple or Nvidia, we are talking about companies with market caps in the trillions, $2 trillion, $3 trillion. These numbers are so large they become abstract. The human brain isn't wired to comprehend a trillion of anything. So let's contextualize it using data from the Bureau of Economic Analysis and the World Bank. A $3 trillion company is larger than the entire GDP of France. It is larger than the entire GDP of the United Kingdom. When you buy a share of Microsoft at these levels, you are effectively betting that this single corporation is worth more than the entire annual economic output of a G7 nation. This brings us to the concept of the gravity of size. In the physical world, the larger an object is, the more energy is required to move it. The same is true in financial markets. This is often referred to as the law of large numbers. It is much, much easier for a company worth $1 billion to double in size than it is for a company worth $3 trillion to double. Think about it. For a $1 billion company to double, it needs to create another $1 billion of value. That's hard, but it happens all the time. A new product catches on, they expand to a new region, and suddenly they're worth $2 billion. But for a $3 trillion company to double, it needs to find another $3 trillion of value. It has to create an entire United Kingdom's worth of value out of thin air. Where does that growth come from? There are only so many humans on Earth with internet connections. There are only so many corporations that need software. At a certain point, a company becomes so large that it starts bumping up against the limits of the global economy itself. It becomes the market. And when you are the market, you cannot grow faster than the market forever. This is why the drop looks different when you understand market cap. When a company is priced for perfection, when it is priced as if it will grow at 20% a year indefinitely, the slightest hiccup brings reality crashing back in. The drop isn't necessarily a sign that the business is failing. Microsoft is a money-printing machine. It is incredibly profitable. The drop is simply the price tag adjusting from fantasy to reality. We have seen this movie before, and this is where the history becomes incredibly instructive. If you look at the data from the late 1990s, specifically around December 1999, Microsoft was the king of the world. It was the crowning jewel of the dot-com boom. It had a market cap of around $600 billion,
which, adjusted for inflation using BLS CPI data, is a staggering amount of money for that era. If you had bought Microsoft stock in December 1999 because you believed in the internet and you believed in the PC revolution, you were right. You were absolutely correct about the narrative. The internet did change the world. PCs did end up on every desk. Microsoft's revenue grew massively over the next decade. Their profits tripled. They dominated the operating system market completely. But if you held that stock, your returns were zero. In fact, they were negative for about 14 years. How is that possible? How can a company triple its profits and dominate the world while its stock price goes nowhere for a decade and a half? The answer is valuation. The answer is market cap relative to reality. In 1999, the price tag on Microsoft was so high, the expectations were so baked in that even incredible performance wasn't enough to justify the price. The company had to spend 14 years growing into the price tag that investors had slapped on it in a moment of euphoria. This is what we call multiple compression. The earnings went up, but the price investors were willing to pay for those earnings came down. So when you see Microsoft drop today, you have to ask yourself, is the business broken or was the price tag just too heavy? This leads us to the psychological trap that catches so many individual investors. It's a behavioral finance concept known as recency bias. We tend to extrapolate the recent past into the infinite future. If a stock has gone up for 3 years, we assume it will go up for 3 more. We look at a chart that goes up and to the right and we feel safe. But in the world of market caps, a chart that has gone vertical is actually a sign of increasing risk, not increasing safety. The higher the price goes relative to the underlying earnings, the less margin of safety you have. When you buy a $3 trillion company, you are paying a premium for safety, for dominance, and for certainty. But if that certainty wavers even a fraction of a percent, the valuation creates a long way to fall. Now you might be thinking, okay, this is terrifying. If the biggest, strongest companies can result in a lost decade of returns, what am I supposed to do? How do I retire? This is where we have to pivot from analyzing individual stocks to looking at the system design of the market itself. This is where the concept of the index fund changes from a boring investment vehicle into a masterpiece of engineering.
Most people treat the S&P 500 like it's just a market average, but it's actually a momentum strategy. It is a self-cleansing mechanism. The S&P 500 is market cap weighted. This means the bigger a company is, the more of the index it makes up. When Microsoft is winning, it becomes a bigger part of your portfolio automatically. You ride the wave up without doing a thing. But, and this is the critical part, when the giant starts to stumble, when the law of large numbers finally catches up to it and the stock price drops or stagnates, it automatically becomes a smaller part of the index. If Microsoft were to enter another lost decade, just like it did in the 2000s, its weight in the S&P 500 would slowly drift down. Meanwhile, the capital that flows into the index would be redirected to the new growers, the new innovators, the companies that are currently where Microsoft was in 1990. You don't have to guess who they are. You don't have to predict the future. The index does it for you. It ruthlessly culls the losers and promotes the winners. It is a survival of the fittest machine. This is important because the data on individual stock picking is sobering. A famous study, often cited in this context, originally by Hendrik Bessembinder, looked at the entire history of the U.S. stock market. He found that the vast majority of stocks performed no better than treasury bills. The entire net gain of the stock market over the last century came from a tiny sliver of companies, about 4% of them. When you try to pick individual stocks, you are trying to find that 4% needle in the haystack. And if you bet heavily on a giant that has already won, you are betting that the giant can continue to defy gravity. But when you own the total market, you are guaranteed to own that 4%. You are guaranteed to own the next Microsoft and the next Amazon and the next company that hasn't even been founded yet. You own them before they become $3 trillion behemoths. Let's zoom out a bit and talk about the macro environment, because the big drop usually happens in the context of the wider economy. The Federal Reserve plays a massive role here.
When interest rates are essentially zero, as they were for much of the 2010s and early 2020s, money is free. When money is free, future profits are valued very highly. Investors are willing to wait 20 years for a payoff because they aren't earning any interest in their savings accounts. This pushes the market caps of growth companies into the stratosphere. But when the Fed raises rates to combat inflation, and we've all seen the CPI prints over the last few years, the gravity gets turned up. Suddenly, a guaranteed 5% return in a boring bond looks attractive. Money gets expensive. The future is discounted more heavily. This hits the high-flying tech giants the hardest. So, when Microsoft drops, it is often just the system adjusting to a new cost of capital. It's not a conspiracy, it's not the end of the world, it's the tide going out. This perspective is vital for your own peace of mind. According to the Federal Reserve's Survey of Consumer Finances, the median retirement savings for American families is alarmingly low. We're talking about tens of thousands, not hundreds of thousands, for many age brackets. The pressure to catch up drives people to take concentrated bets. They see Microsoft or Nvidia soaring and think, that's my ticket. If I put everything there, I can double my money quickly. But that is a trap. That is how you get caught in the valuation crush. If you buy at the top of the hype cycle and the stock goes sideways for 10 years, you have lost your most valuable asset, time. You cannot get those 10 years of compounding back. The alternative is what I like to call aggressive patience. It's the willingness to be bored. It's the understanding that a 7 to 10% average annual return, which is the historical average of the U.S. stock market over long periods, is actually a miracle. Albert Einstein is often misquoted as calling compound interest the eighth wonder of the world. Whether he said it or not, the math holds up. If you understand market caps, you realize that you don't need to find the one company that will go up 1,000%. You just need to capture the productivity of the entire human economy. Think of the global economy as a giant engine. It is fueled by population growth, innovation, and efficiency. Companies like Microsoft are huge pistons in that engine. But pistons wear out. They get replaced. New, more efficient parts are invented. If you invest in the engine, the index, you don't care which piston is doing the work. You just care that the engine is running. When Microsoft drops, the engine is still running. The value that was lost in Microsoft's market cap didn't disappear from the universe, it moved. Maybe it went to energy companies. Maybe it went to healthcare. Maybe it went to bonds. Maybe it went to a startup that will IPO next year. This detachment is your superpower. When you stop identifying as a Microsoft shareholder or a Tesla shareholder and start identifying as a capitalist, someone who owns a piece of the entire system, the volatility loses its sting. Let's go back to that bathtub analogy. If you're sitting in a bathtub and you have a rubber duck and you push it down, it pops back up. That's a small cap stock, volatile, jumpy. But if you have a massive block of lead in the tub, that's your mega cap stock. If that block of lead slips, it crashes through the bottom of the tub. The damage is structural. The market cap of these tech giants has become so large that they are now systemic. They are held in almost every pension fund, every 401k, and every endowment. This means that everyone is correlated. If Microsoft sneezes, your retirement account catches a cold, even if you think you're diversified. This is why understanding the weighting of your investments matters. If you buy an S&P 500 fund, you might be surprised to learn that nearly 30% of your money is in the top handful of tech companies. You are not as diversified as you think. You are effectively making a massive bet on big tech. Is that bad? Not necessarily. These are the most profitable companies in human history, but you need to be aware of the concentration risk. This is why some investors look beyond just the S&P 500. They look at total world indices or small cap value funds to try and dilute that concentration. They are trying to escape the gravity of the giants. But let's bring it back to the drop. The headline says Microsoft plunges. The pundits scream tech wreck. Your instinct is to sell. Your instinct is to protect what you have. But if you sell after the drop, you are locking in the loss. You are reacting to the price, not the value. Remember, the market cap is just the price tag. It changes every second. The underlying value of the business, its ability to generate cash flow, changes much more slowly. If you are a net buyer of stocks, meaning you are still working, still saving, and have years before retirement, a drop in market cap is actually a gift. It is a sale. You are getting to buy more shares of the global economy for fewer dollars. You are acquiring future cash flows at a discount. The problem is our brains are wired for the savannah, not the stock market. On the savannah, if you see the herd running, you run. You don't ask why, you run because the ones who stopped to ask questions got eaten by lions. In the market, if you run when the herd runs, you get eaten by inflation and transaction costs. You have to be the one standing still. You have to look at the $3 trillion market cap and say, okay, it's correcting. That is what math dictates it must do eventually. There is a freedom in this. There is a freedom in knowing that trees don't grow to the sky. When you accept that a company cannot outperform the economy forever, you stop chasing the past performance. You stop looking for the next Microsoft and start appreciating the boring, steady grind of broad diversification. So the next time you see that red arrow next to a ticker symbol like MSFT and the talking heads are predicting the end of the tech dominance, take a breath. Look at the market cap. Remind yourself that a correction in a $3 trillion asset is normal. It's healthy. It's the tide going out. Your job isn't to predict the drop. Your job is to survive it. Your job is to keep buying the index, keep your costs low, and let the gravity of the global economy work in your favor, rather than trying to fight the physics of valuation. The market is a mechanism for transferring wealth from the impatient to the patient. The impatient look at the price drop and panic. The patient understand the market cap, understand the history, and they stay the course. Be the patient one, because in the long run, the only thing that matters is that you own a share of the future, regardless of which company happens to be sitting on the throne at any given moment.